Hello, I'm Marius Alexa. Welcome to this new edition of the weekly foreign exchange outlook here on JitneyTrade TV. JitneyTrade TV, the market information side of JitneyTrade. Quite a couple of things have happened in the market this week, and I have some short and intermediate term ideas to share with you. So I think we will really not waste any time, and we'll go directly to the charts. Basically, the first idea to share with you is that the USD CAD is near a dip. Gold and euro are probably due for a consolidation pullback. But actually, first things first, I want to share with you why I think that the Fed really doesn't know anything, and why I firmly believe that what they have done this week will end up being could end up being a terrible mistake on their part, because they have really, in my opinion, done nothing else but fire in the air. They used very unwisely, in our opinion, the last bullet that they had by adopting that 0% interest rate policy. So really, they really don't know anything. Let me tell you why we think that's the case. The problem in the financial system at the moment was not necessarily the level of interest rates. Much like the Fed was probably adopting the wrong stance when they kept interest rates too high at the beginning of the crisis, I think they're now overshooting quite dramatically, because really they're wasting in the air that last bullet of 1% interest rate cut they previously had. At a time when really the problem in the financial markets, in the financial system, is not the level of the interest rates, but money velocity, meaning that liquidity is being injected, but psychology is so depressed that people don't lend to each other, and the credit is not being extended between institutions and to businesses. And I think that at the end of the day, what this 0% interest rate policy can do is nothing else but to reduce even further the money velocity, exacerbating further the issues in the financial system, because really, what incentive is there to lend at 0%? I think again, it was something that I personally didn't expect. I think it changes the rules of engagement in the markets for 2009, and in that respect, probably 2009 is going to be about a potentially serious dollar problem. Dollar problem which we're starting to kind of see. We actually started seeing it some while ago near the 650, 680 area in the gold. There must be a reason for which gold dropped in a corrective structure from the 1030 high. There must be a reason why it fiercely respected that guideline of wave formation, according to which corrections bottom within the price territory of previous fourth waves. For all intents and purposes, the gold market is starting the engines for some type of flight here. We will see whether we end up only with a retest of the 1030 highs, or if we already charge higher sometimes in early 2009. But for all intents and purposes, this piece of news from the Fed comes right past a gold market bottom, and once again the market knew things better and did a couple of things in advance, because the gold had already recovered about $150 off the lows before Fed went to 0 interest rates. Now, the other chart to show, and here the situation on intermediate term basis is not that bad yet. Probably, the Canadian dollar is being hurt even further by, the weakness in the energy markets. And because on a relative basis, he was absolutely killed this past week against the euro, against the Swiss franc in particular, against the, British pound, against the Japanese yen, and so forth. I believe that right now USD CAD is sitting at the low end of the range. We visited that 117 area, which we discussed in a previous update as the likely target for the mid to late December. We've tested that support. We're probably in a position to rebound right now. Begin by forecasting some type of little limited bounce, but get a bit more excited if we cross the 120, 130 area, because really we would be due for a return probably towards the 126, 128 marks. The euro dollar in the previous week, was trying to call for that bearish triangle, and then for a final thrust, we mentioned that the 135 was critical resistance. We got a breakout, joint breakout in price and momentum at 135. Obviously, subsequently, the market rallied another 10 big figures following the Fed announcement, topping, near the 62% retracement of the move down from 160.5 to 123.5, and at the 200-day moving average. Things have gotten a bit extreme in the short term. A pullback is probably due. The target range is likely 138, 140. We should retest those supports and then turn back up. Finally, spot gold. I think, we discussed in the previous update how, gold was looking bid in the daily chart and all that stuff. We're seeing further signs of strength this week with an attempt, to break to the upside in the relative strength indicator. We're trying to kind of hug several times, up and down the 200-day moving average. There is some resistance at the 888.95. It should yield only a limited pullback, 788.20 eventually. I think that the 820 is good support for now. If we just slip under it, we'll retest the 780 before turning back up. Triggering above the 880, 890, $5 an ounce would automatically lead to a larger rally towards the 935, 970 in the spot gold, pretty much, immediately. And last but not least, because obviously this is going to be my last update for 2008, I want to thank you from the bottom of my heart for watching us in 2008. I hope that, we could make a difference. I hope that, it's sure thing we haven't been perfect, nobody is, but I hope that we've done more good things than bad ones. And I'm going to wish you a Merry Christmas, a happy, healthy, prosperous New Year, and we'll definitely see you in 2009. Cheers.